Anthony, what are the current disclosure requirements?
Well, I think, Becky, the important ones are dictated by the SEC, and most companies should go back to the current 8K rules. The 8K rules are easily understood. They are broken down into major components. A few of those components I want to bring to you, our discussion today includes the concept of reportable events, the concept of material definitive agreements. There are a few that most companies had fallen short in disclosing. For example, the change of auditor, or if they sell unregistered securities to the marketplace, or if they have material impairments. Some of these items have been clearly described in the 8K requirements, and I think most companies should be conversant about them. And of course, with the Sarbanes-Oxley Act, with the requirement of the 302 certification, I would encourage companies to go back to the 302 rules and the 404 disclosure requirement. That way at least they can be integrated into a very simple process.
What transactions or events should be considered for disclosure?
Becky, I think we talked about material definitive agreements such as acquisitions, dispositions. Of course, if you are exiting a particular business, the cost of exiting, if you entered into some side agreement, and if the consequence of that agreement are critical and important, those should be considered. If a company receives a delisting notice, some of those items, again, that they are listed out in the 8K requirement. But more importantly, people may ask themselves the question, how about related party transactions? There are certain events that are not in a bright line. They're not black and white. Now, these are the areas that some companies have fallen short in complying with the rules. And again, if those transactions had happened, and if they're important enough that the board should know about, if the related consequences should be evaluated from a financial reporting perspective, whether they're on balance sheet or off balance sheet, they're equally important to be considered for disclosure. That is why disclosure controls, inclusive of those areas such as related party transactions, to the extent if an event could trigger a conflict of interest, something of that nature that would spur the attention of a prudent investors, absolutely that should be considered.